Warren Buffett is worth over $100 billion. He started with nothing. No inheritance, no rich parents, no lucky breaks. Just a handful of rules he's followed religiously for 70 years. And the crazy part? They're not secret. He's been saying them publicly for decades, but almost nobody actually follows them. These aren't hacks or shortcuts. They are fundamental principles that work at any income level for anyone willing to apply them. Let's start with his most important rule. Rule number 1, never lose money. And rule number 2, never forget rule number 1. It sounds obvious, but here's what he means. Most people focus on how much they can make. Buffett focuses on how much he can avoid losing. Because a loss doesn't just cost you the initial money, it costs you the compound growth that money would have generated forever. If you lose 50% of your portfolio, you need to make 100% just to get back to even. The math of loss is brutal. So how do you avoid it? You don't chase hot stocks, you don't invest in things you don't understand, you don't panic sell during a crash. You buy solid assets you're confident will be worth more in 10 years, and you hold on. Boring beats exciting every single time. Buffett's second core rule is to live below your means, way below. This man is worth over $100 billion and still lives in the same house he bought in 1958 for $31,000. He drives a modest car. His lifestyle is indistinguishable from an upper-middle-class retiree. This isn't because he's cheap. It's because he understands that every dollar you spend on lifestyle is a dollar that's not compounding. Most people get this backwards. They increase their spending every time their income goes up. Buffett did the opposite. As his income rocketed up, his spending stayed flat. The gap between what he earned and what he spent became his investment capital. That gap is what made him rich. The third rule is the engine of it all. Compound interest is your best friend. Buffett calls it the eighth wonder of the world. And get this, 99% of his wealth was built after his 50th birthday. Not because he got lucky late in life, but because that's how compounding works. It starts slow, then it explodes. He became a millionaire at 30. He hit his first billion at 56, but he didn't reach 100 billion until his late 80s. The first decade builds the foundation, the second builds the walls, the third builds the skyscraper. Most people quit too early because they don't see massive results in the first few years, but you can't skip to the end. Time beats money, every time. Those three principles are powerful, but the next two are what separate Buffett from almost everyone else. His fourth rule is about emotion. Be fearful when others are greedy, and greedy when others are fearful. When the market is euphoric and everyone is buying, that's the time for caution. When panic sets in and everyone is selling, that's when real opportunities appear. He buys excellent companies when they're on sale due to irrational fear, not because their fundamental business is soured. And finally, his fifth rule is about discipline. Invest within your circle of competence and always demand a margin of safety. In other words, if you don't understand how a business makes money, stay away. Don't pretend to be an expert on everything. And even when you find a great business you understand, only buy it when the price is significantly below its true value. That cushion, that margin of safety, is what protects you from bad luck and your own mistakes. Never lose money, live below your means, let compounding work its magic, act rationally when others are emotional, and stick to what you know. That's it. It's not genius. It's a simple framework of discipline and patience followed relentlessly for a lifetime. And it's why Warren Buffett won the game. Warren Buffett has a rule that's kept him out of every major speculative bubble for 50 years. The dot-com bust, the crypto craze, he avoided them all. He calls it his circle of competence. The principle is simple. If you can't explain how a company makes money in one sentence, you shouldn't own its stock. Think about what Buffett invests in. Insurance, banks, railroads, consumer goods, boring businesses that have been around for decades. He doesn't invest in tech startups or biotech, not because they're bad, but because they're outside his circle. And investing outside your circle of competence is gambling, not investing. You might get lucky, but you can't consistently win at a game you don't understand. Most people do the exact opposite. They chase whatever's hot: crypto, meme stocks, NFTs, whatever everyone's talking about. They invest in things they don't understand because they're afraid of missing out, and they lose money consistently. Your circle might be different. Maybe you understand real estate or e-commerce or an industry from your career. Whatever it is, stay inside it, master it, and invest there. You'll make more money being an expert in a narrow field than a novice in 100. But there's a final rule, and this one is the most important. Invest in yourself first. Before Buffett invests a single dollar in the stock market, he invests in knowledge. The man reads 500 pages a day, every day. He estimates that 80% of his working time is spent just reading and thinking. Here's why this matters more than anything. The best investment you can make is in your own earning power and financial intelligence. A degree, a skill, a certification, a book that changes how you think about money. These have an unlimited return on investment. Think about it. You spend $1,000 on a course that teaches you to negotiate your salary, and it helps you earn $10,000 more per year for the next 30 years. That's a $300,000 return on a $1,000 investment. That's a 30,000% return. You will never find a stock that does that. If you spend 10 hours learning about index funds and compound interest, that knowledge helps you avoid expensive mistakes and optimize your investments. You just added hundreds of thousands of dollars to your lifetime wealth. 10 hours for an infinite return. Buffett says the best investment he ever made was a $100 Dale Carnegie public speaking course. It gave him the confidence to teach and pitch investors. That $100 course arguably made him billions. Most people have this backwards. They'll invest $10,000 in stocks they don't understand, but won't spend $100 on a book about investing. They'll put money into crypto, but won't invest in learning how it actually works. They chase returns, but won't invest in the knowledge that generates those returns. So here's the bottom line. Warren Buffett's rules for getting rich are simple. Never lose money, live below your means, let compound interest work for decades, only invest in what you understand, and invest in yourself first. These aren't secrets. Buffett's been saying them publicly for 70 years, but knowing and doing are two different things. Most people know they should save more, spend less, invest consistently, and educate themselves, but they don't do it. They chase shortcuts. They inflate their lifestyle. They invest in things they don't understand, and they lose money consistently. Buffett followed these rules religiously. He started with nothing and built $100 billion. You don't need to build $100 billion, but if you follow the same rules, you can build financial independence. You can retire comfortably. You can win the game. The rules are simple, but simple doesn't mean easy. It means you have to do the work. Start today.